Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Okay, good morning, everyone. I apologize that for Monday's lecture recording, I think the last 30 minutes wasn't recorded for the audio. So I think it's good that we recap some of the stuff from Monday's lecture before applying those knowledge to solving numerical examples, all right? So today's workshop is still about delta hedging. So we're delta hedging with different derivative contracts. So the first example is delta hedging with futures contract. So I think it's a good opportunity for us to have a recap about delta hedging with forward contract as well as with futures contract. All right, so delta hedging with forward contract is simple. So as I mentioned in Monday's lecture that the delta for the forward contract is always 1, okay? So forward contract value has 100% positive correlation with the underlying asset price. Why that's the case? Okay, so first of all, when the forward contract just entered into, it has no value, right? Because anybody can enter into a forward contract. And as we learned in week 2, moving through time, the forward contract would either have a positive value or negative value, right? Because the underlying spot price changes over time. So for instance, the way we value a forward contract is simply by taking the most updated spot price, subtract the present value of the delivery price, okay? So basically, you are comparing the spot price with the price that you lock in, all right? So imagine that you loan a forward contract, right? And you lock in a price, then at some time past, you go back to the forward contract, you try to revalue it, you realize that the spot price has actually increased. Therefore, it has a positive value to your forward contract, right? Because you lock in to buy at a lower price. Now, if somebody else wanted to buy the same asset, they have to pay a higher price based on the most updated spot price, okay? And we know the K, the delivery price, is fixed. You know, you're discounting the delivery price back to the point that you're revaluing this forward contract. Now, the only thing that changes is the underlying asset price, right? So if the spot price increased by $1, then the value of the forward contract would increase by $1 as well. So if you're plotting the forward contract value against the underlying asset price value on a graph, you'll realize that they have 100% positive correlation. So for that reason, the forward contract always have delta 1, okay? So if you loan a forward contract, that's positive 1. If it's short forward contract, it has a delta of negative 1. So to neutralize the exposure that you have to the forward contract, if you take a long position in the forward contract that creates a positive 1 delta, you need to short 1 unit of underlying asset to create a negative 1 delta to cancel it out. And vice versa, if you short a forward contract that creates a negative delta, and then you need to buy 1 unit of underlying assets to create 1 positive delta to neutralize that. All right? So that's with the forward contract written on stock that doesn't pay a dividend yield. So if the forward contract is written on a stock that pays a dividend yield, then same as before, we're simply removing the effect of dividend yield from the delta. So instead of having delta of 1, we're having a delta that's slightly less than 1. So that's basically 1 times the e to the power of minus qt, right? Basically what we're saying here is that instead of buying 1 unit of stock, we can buy the amount that's less than 1. The reason is because the underlying asset pay a dividend yield, and perhaps we can use the dividends to reinvest in the same stock so that we don't need to invest in 1 stock, but in the amount that's less than 1. So if you're dealing with forward contract written on foreign currencies, then same thing apply. Basically, you're removing the effect of foreign risk-free rate from the delta. So that's simply e to the power of minus RF times t, right? So that's the delta with the forward contract. It's quite straightforward. Now, what about the delta on the futures contract? So if you think about the major difference between futures contract and the forward contract, is that with forward contract, there's only one shot cash flow, right? And that we know the precise timing of that cash flow is at the maturity date, right? So all of the cash exchanging hands at the maturity date. So there is no intermediary income during the life of the forward contract. What about the futures contract? Remember back in week 2, I said, when you try to establish a position in your futures contract, you need to establish a margin account with your broker as well, right? So the way the margin account works is that the daily gain and the losses are posted to your margin account, right? And the balance in your margin account is earning the risk-free rate on a daily basis because of the daily settlement feature with the futures contract, right? So if that's the case, then basically the balance in your margin account associated with the futures contract is earning a risk-free rate every single day. So that's like an income source, right? That's like an income yield. In other words, we can trade the risk-free rate as the dividend yield for the futures contract. So similar to the case where we have a forward contract written on a stock that pays a dividend yield, we're going to trade the futures contract that paying a dividend yield that equal to the risk-free rate, the little r. So the futures contract has a delta of 1, but again, we need to remove the effect of risk-free rate from that 1 delta. So that becomes 1 times the e to the power of minus RT, right? So that's basically what it says. And the situation becomes slightly more complicated if the futures contract is written on the underlying asset itself pays the dividend yield. That's okay, because we do the same thing as before. We subtract the dividend yield from the risk-free rate. Then we're removing the difference from the delta, right? So basically, that's just e to the power of minus brackets r minus q times t. So if you're dealing with the futures contract, they're written on foreign currencies, and once again, remember to subtract the foreign risk-free rate from your domestic rate, right? So basically, we're just modifying this equation based on the underlying assets, right? So does that make sense? The delta with futures contract? Any questions about the delta with futures contract? Are we cool? Okay. So that's just a quick recap from Monday's lecture, and let's have a look at this question here. It says, you have been employed by an Australian option dealer to keep an eye on exposure to the currency options, and one area of concern that you have identified is dealer's exposure to pound sterling. So currently the dealer is making sure that the portfolio of 11 months put option on pound sterling is kept delta neutral by making a short position in 978,000 pounds. So rather than using a position in pound sterling, and you advise that the bank should take a position in the 11 months futures contract on pound. So further, you have identified that the risk-free rate in Australia is 6% per annum, and the risk-free rate in UK is 7.5% per annum. So both are continuously compounded. And first question says, if the dealer were to take your advice, how could the 11 months futures contract on pounds be used to make sure that the dealer's position in the currency option kept the delta neutral? So let's walk through the question. So first of all, we were not told what kind of position the dealer is taking on this put option, right? So this is a put option written on foreign currencies. And the question didn't tell you which position the dealer is taking on the put option. But the only thing we know is that the dealer has to take a short position in the underlying foreign currencies to keep the portfolio delta neutral, right? So as I mentioned in Monday's lecture, the delta neutral means the overall delta in the dealer's portfolio has to be 0. That's delta neutral. Well, so let's think about what kind of delta you're getting from shorting the underlying currencies. If you short underlying currencies, you're getting negative delta, right? That means the dealer is trying to create some negative delta to neutralize the delta exposure on his portfolio. So it has to be the case that the delta are exposed into positive delta, right? So what kind of position in the put option give you a positive delta? Any ideas? What kind of position in put option give you positive delta? Short, right? Because we know long the put give you negative delta, then short put give you positive delta. So we kind of work backwards to back out the position the dealer is taking on the put options. So here's the logic. We know, only thing we know is the dealer is shorting the currency, so that implies the dealer wants negative delta, all right? That means the dealer is exposing to the positive delta on whatever position he's taking on the put option. And we know that only when you short a put, that would give you a positive delta, okay? Now, what kind of position the dealer has to take in the futures contract? We know that long the futures contract give you positive delta, right? Because long the futures contract is similar to long the underlying asset. So we need to short the futures contract to create negative delta, to neutralize our positive delta exposure that we have on this short put. Yes? So basically the whole scenario is that you advise the dealer, instead of taking a position in the underlying foreign currencies, you suggest the dealer should take a position in the futures contract that return that foreign currency, right? And as I mentioned before, basically take a position in the futures contract is similar to take a position in the underlying assets. If the dealer were to take a short position in the pound, then the dealer needs to take a short position in the futures contract that return on pound sterling. So that's the logic. All right, so we know the position to take on the futures contract. Then the next question is how much, right? And we can work out what is the delta on one futures contract that return on pound sterling. We can do that. Because as mentioned before, the delta on the futures contract is simply 1 times the e to the power of minus RT. But one little modification is that we're dealing with the futures contract return foreign currencies. So same as before, we need to remove the foreign currency, the foreign risk-free rate from our domestic risk-free rate. Then we can calculate the delta on the futures contract. So this is the correct formula to use. So we were told that Australia's risk-free rate is our domestic rate, and the UK's risk-free rate is the foreign rate. So in the bracket, that is 6% minus 7.5%, all right? And times time to maturity, 11 over 12, and we work out the delta is slightly greater than 1, which is 1.0138. Okay, and how much exposure we have? So we have the exposure of 978,000 pounds sterling, right? So that delta times the exposure, and we work out approximately 991,000. So basically, we need to short sufficient futures contract that return on pound sterling to cover roughly 991,000 pounds. Okay, so that's how you answer this question. So we don't know how much per contract is covering. We only know how much contract we need to short. We only know that we need to cover this much to be equivalent of shorting in the underlying foreign currencies. So the way we answer this question is that we need to short, enough futures contract that return on pounds to cover this much, to be equivalent of taking a short position in the underlying foreign currency. Does it make sense? I think it's quite straightforward, right? So any question on this first question, first example? Nope. All right, so the next example is delta hedging with European stock options. So again, as I mentioned, for those who came late, the last 30 minutes audio on the Monday's lecture was lost. So before we do this example, I feel like it's a good opportunity to recap some of the stuff that's missed out in the last 30 minutes lecture. So basically, we know how to do the delta on the European stock option. So what about the delta hedging with European stock option with a dividend yield? So one thing I have to remind you is that instead of using your regular D1 formula, we have to use the D1 formula that's based on the options that's written on the stock that pays the dividend yield. Well, we know the modification, which is the risk-free rate minus the dividend yield Q, right? So that's the change with the D1 formula. By the way, this formula is not given, okay? You only get the regular formula in your final exam. And then what we do is we calculate D1, we find ND1 based on the D1 value. And then we argued among this lecture that if you short this option, which means you need to buy the underlying stock, instead of buying ND1 amount of stock, you buy the amount that's slightly less than ND1. So how much you're buying? You're buying ND1 times the E to the power of minus QT. The reason is because the underlying asset pays the dividend yield, and we can use that dividend yield to reinvest back in the very same stock. So instead of buying ND1 amount of stock, we can buy the amount that's less than ND1, which is discounted by the rate of Q. All right, so, and similarly, if you're dealing with the option written on foreign currencies, then you need to use the D1 formula that dealing with foreign currency. So that's R minus RF here. And instead of buying ND1 amount of stock, you're buying ND1 times the E to the power of minus RF times T. Okay, so, all right, so, okay, let's proceed to our workshop example here. So the second example says, an option trader, you just sold a call option for purchase of 1 million shares. The current spot price is 49, strike price is 50, risk-free rate is 5%, time to maturity is 20 weeks, and the volatility on the underlying stock is 20%. So how would you implement a delta hedging strategy to neutralize your current short position in the call? Quite straightforward. We know shorting the call gives you negative delta, right? Because long the call gives you positive 1, short the call gives you negative delta. However, we know buying the underlying stock gives you positive delta. So we need to take a long position in the underlying stock, and the amount we're going to take is ND1, right? So it's just a matter of calculating your ND1. So that's your regular D1 formula. So we know the spot price is 49, strike price is 50, plus the risk-free rate 5%, plus the variance divided by 2, times time to maturity, then divided by sigma, times square root of 20 over 52, because it's weeks, right? So 52 weeks in a year and matures in 20 weeks' time. So we work out the D1 is 0.05. We go to our table, we find the corresponding ND1, 0.5199, right? So we write it down. And then that's simply the delta on one call option multiplied by the exposure, because we short option that covers 1 million shares, so our exposure is 1 million, times 1 million, so that's roughly 519,000 shares. So if you short options that cover 1 million shares, you need to long 519,000 shares to neutralize your delta exposure. Okay, so this is the same stuff we've been talking about in Monday's lecture. Okay, so this is what I mentioned before. So if you're dealing with the options that written on the underlying asset that either pays the dividend yield or that written on foreign currency that pays the foreign risk-free rate, we need to subtract that from the risk-free rate. So here is one question. So this question is taken from your past exam paper. So this will be a typical question you get for delta hedging. So the question says, Australian bank has sold 13-month European put options on 100 million euros with a strike price of 1.43. So that's you're spending $1.43 Aussie dollar to buy 1 unit of euro. So the current spot rate is 1.51, and the risk-free rate in Australia, the domestic rate, is 4.5%, continuously compounded, and the risk-free rate in Eurozone is 1.5. And the volatility on euro is 15% per annum. How would the bank implement a delta hedging strategy? So the question explicitly tells you that assume Australia is the home currency and the Eurozone is the foreign currency. Euro is the foreign currency. So we know that we cannot use the regular D1. We're using the D1 that dealing with the foreign currencies, right? So they're just subtracting the foreign risk-free rate from your domestic rate. And we know the spot price is $1.51, divided by the strike price, $1.43, and the rate in Australia is 4.5%. The foreign rate is 1.5. So the volatility is 15%, that's square, and time to maturity is 13/12. Okay? Then we work out our D1 is 0.63. So we go to our table, we find the corresponding ND1 is 0.73557. However, we are dealing with the put options, right? So with the put option, the delta is ND1 minus 1. So that's what we talked about on Monday's lecture. So if you take the first derivative of the call option price with respect to the share price, what you're getting is ND1 minus 1. All right? But that's just the delta on your regular put option. We're dealing with the put option written on foreign currencies, right? So in other words, we don't need to hedge the full amount. So this is the full amount. ND1 minus 1 is the full amount. We hedge the amount that's slightly less than this. So that is the ND1 minus 1 discounted by the risk-free rate, the foreign risk-free rate. And again, because we are shorting the put options, right? So we know short the put option, you must get positive delta. So we put a negative sign in front of this to make sure that we're getting a positive delta at the end. Does it make sense? So if you don't do this negative sign here, what you are getting is a negative delta. All right? But maybe it depends on your preference, okay? So you don't have to do this negative sign in the middle of the calculation. So if you understand that shorting the put give you positive delta, you can get a negative answer here, but write another sentence, say, because we're shorting the put, so the delta is positive. So you convert that into a positive amount. Then you're using the positive amount to work out how much position you need to short in the foreign currency. So everybody understand what I'm saying? Okay, so because we're shorting the put, so we're putting a negative sign here to make sure we're getting a positive delta. And that's your ND1 value, minus 1, discounted by the foreign risk-free rate. So that's the delta for one unit of put option that we shorted, 0.26. And how much we short? We short put options that cover 100 million euros, right? So that's our total exposure. That's 1 unit of delta on 1 unit of put option that we short. And you multiply by that, you get 26 million. 26 million euros, yes. So in other words, we need to short 26 million euros to neutralize our positive delta from the short position in the put option. Does it make sense? Any question on the third example? So any question on the third example? All right, so part B of the third question says, you are loaning a 3-month forward contract on 500,000 US dollar, and the risk-free rate in Australia is 4.5%, continuously compounded, and the risk-free rate is 1% in United States. So how could you make your position in the forward contract on US dollar delta neutral? So you can assume the Australian is the home currency and the USA is the foreign currency, right? So as I mentioned before, loan the forward contract is similar to loan the underlying asset. So loan one forward contract give you, so the forward contract always give you 1 delta, right? It's delta of 1. However, we're dealing with the forward contract that written on foreign currencies, so we need to do a bit of modification here. So basically, we're discounting that 1 delta with the foreign risk-free rate for the reason I just mentioned earlier in the workshop. And we know what the risk-free rate is. The risk-free rate in the United States is 1%, right? So that's 1 delta times the e to the power of minus 1% times 3/12, and not surprised, we're getting a delta that's slightly less than 1, which is suggesting that we don't have to hedge the full amount of delta. We just need to hedge the amount that's slightly less than 1, because we can always reinvest the foreign risk-free rate income back in the foreign currency. And we loan the forward contract that covers $500,000, so that's our total exposure, 0.99 times $500,000, and we get approximately $498,000. So in other words, we need to short $498,000 to neutralize our positive delta on the long position on this forward contract. Okay, so the last bit is the delta on a portfolio. So usually in real life, the dealer would have a portfolio of different positions in the option that written on the same stock. So in that kind of scenario, we can aggregate all the deltas from different positions to a net delta on this portfolio. So let's read the question first. I'll explain in detail. So basically, suppose the bank has following 3 options in a position in a stock. Okay, so the same stock. So basically, this bank has taken different positions in the option that written on the same stock, and the option perhaps have different strike price and different time to maturity. That means the different position would come with different delta. So the first bullet point says a long position in 100,000 call options with strike price of 55 expires in 3 months' time, and we don't need to calculate the delta, so the delta is given by the question. So delta for each option is 0.533. But one thing I want to remind you guys is that when the question tells you the delta for each individual option, they're always expressed in the long position in the option. In other words, you have to figure out yourself whether the delta is positive or negative by reading the question carefully. So the question would always give you the delta on the long position in 1 unit of option. So that's okay, because in this first bullet point here, we take a long position in the call option, so that would give us positive delta anyway, right? So we don't have to worry about it. So the delta for one option is simply 0.533. And the second bullet point says, the bank also have a short position in 200,000 call options with a strike price of $56 and expires in 5 months' time. So again, the question gives you the delta as if you take a long position in the option, it's positive 0.68. But we know when you short call, you always get a negative delta, right? So automatically, when you read the question, you write negative 0.468 on the side. So lastly, the question tells you a short position in 50,000 put options with strike price of 56 and expiration date in 2 months. And again, the question gives you the delta on long position in the put, so that's negative 0.508. And it's your job to figure out that shorting the put gives you positive delta, so you quickly write on the side, that should be positive 0.508. So how could you make your portfolio delta neutral? How can you get rid of the total delta exposure? Well, you simply aggregate all the deltas across different positions. Okay? So you aggregate by the weighting in different positions. So that's your weight. So W is the weight, which is the quantity, the number of options that you long or shorted. And that's the delta on one individual option. Okay, so you aggregate that, that's the summation, you get the aggregate delta on your portfolio. We know how to do that. So the first position, remember the first bullet point says you take a long position in the call. So each long position call give you a positive delta, and that's the exposure. So what's our second position? Your short call options, right? So shorting call options give you negative delta. So again, once we put a negative sign in front of that, that whole component is a negative delta exposure, right? So they just delta on one individual call option times the total quantity, which is 200,000, and aggregate, that's a negative delta. And then lastly, we short a put option, right? So shorting the put option gives you positive delta. And so that's the negative sign in front of that to cancel out negative sign here. So this position should give you a positive delta. Shorting the put gives you a positive delta. So delta on each option times the quantity, and you work out the aggregate delta is negative. So negative 14,900, right? Now, if you have negative delta, you want to buy the underlying asset to create positive delta to cancel it out. All right? So that's how you deal with the delta at the portfolio level. Nothing difficult, you just need to figure out whether the delta is positive or negative by reading the question carefully. Yes? Yes. That's okay, because remember, delta is constantly rebalanced. That just aggregate delta at one moment in time. But maybe an hour later, you have to rebalance it again. So as those delta maturing over time, your position in the underlying stock also change over time. Yeah. So for example, if the stock price increased, then that would increase your delta exposure. So this negative amount would become smaller negative amounts. Then remember, you bought this much stock, then you have to sell a little bit stock. So to reduce your position in the underlying shares, right, to make sure that's delta neutral. Very good question. Thank you. Any other questions? Any other questions? All right, no? Okay, so because in Monday's lecture, for those who didn't attend the lecture, probably missed out the last two questions I demonstrated. So for those who not interested in listening again, you can go home now. So I'll just talk through these two examples again for those people who didn't attend Monday's lecture. Okay, so basically I taken these two questions from your final past exam paper. All right? So basically with this sort of question, you have all the knowledge you need to solve it, but you probably never encountered this question before. So the question says, you've completed this unit and you decide to put your knowledge of options into practice. So basically what you did is you created your very own over-the-counter option called Canberra option. Okay? And this option is written on the All Ordinary Index. So for those who don't know, All Ordinary Index is the index in Australia. So automatically you'll be thinking multiplier of $25, right? And it has a life of 6 months, can only be exercised at maturity. So in terms of the payoff structure from this option, if the value of the index falls between now and maturity, you get a payoff of 0. But if the index increases between now and maturity, the payoff is a fixed percentage of the increase in the value of the index. So is this option described above a call option or a put option? Okay, so basically the last paragraph gave it away. The last paragraph says, if the index increases, you're getting a fixed percentage based on the increased magnitude of the index, right? So when you increase, you get a payoff. When the index decreases, you don't get a payoff nothing. Sounds familiar, right? What kind of option give you a payoff when the underlying asset increase and nothing when the underlying asset falling below the strike price? Well, a call option, right? So the logic is here, because if the index increase, you get a payoff. Index decrease, you don't get a payoff. Only the call option having this sort of feature. So this Canberra option is clearly a call option. And then the next part of the question says, if the V is the current level of the index, and the ST is the value of the index in 6 months' time, P is the fixed percentage that the purchaser of the index would receive if the all ordinary index increase between now and maturity, what is the payoff to the writer of this option? Okay, so the question is asking for the payoff for the writer of the option. Okay, basically we can work out what is the payoff the holder of the option receive if the index increases, right? So if the index increases, then the holder of the option will receive the fixed percentage, which is expressed by the P, times the magnitude of increase. So we have to work out the magnitude of increase. Well, the magnitude of increase is simply the difference between the index value in 6 months' time, ST, compared to the current level, V, right? So when the option increases, the option holder will get ST minus V times the fixed percentage P. Okay? Because we are the writer of the option, so we have to pay out that much. So there's a negative sign in front of that payoff. And as the writer of the option, we also get option premium, C. So that's the premium you receive up front. So that's what you receive minus what you paid out. Okay? And remember, this is the option written on index. So remember to multiply the $25 multiplier on this payoff. So that's the C minus this whole equation here. Okay, so that's the first example. So the second example says, again, you're going to create your own derivative contract, and the contract would provide a payoff of a fixed $100 for every 1% increase in the index between now and the 30th of December. So if the index falls, the contract would give you a zero payoff, and we were told the L is the value of the index today, and the J is the value of the index on 30th of December, and S is the cost of derivative today, cost to set up this derivative. And you are the seller, you are the writer of the derivative contract. What is your payoff from derivative? Okay, so if the index increase between now and December, if the index decrease between now and December. So we were told if the index decrease, you get a payoff of zero, right? So as this option writer, if the option is out of money, then holder of the option will not exercise, and you can walk away with the premium S for doing nothing. So the payoff to you as the writer of the option is simply S. Now the only difference between this question and the previous question is that the payoff in this question is based on the percentage change, whereas the payoff in the previous question is based on the change in the magnitude, right? Now, we know how to work out the percentage change because we learned the formula how to calculate percentage return. So the way you calculate the return is by taking the final price, we know the final price is J, divided by the initial price L, subtract 1, and multiply by 100, so that gives you the percentage changes in the index value. And then we know that for every 1% increase, you get $100, right? So it's $100 multiplied by this whole equation here. And then once again, because you're the writer of the option, you will receive the premium. So that's what you receive minus what you paid out. Okay? So that's basically all for the question 2. Any questions with these 2 questions? All right, if not, so that's all for today's workshop. Thanks, everyone. By the way, your quiz next week is based on the Greek letters, okay? Thanks.